Welcome to this ACCA video. If you are studying SBR at Strategic Professional, this video is aimed at you. My name is Tom Clendon and I'm an experienced lecturer in preparing students for their ACCA examinations. This video will debrief question 3 from the first ever SBR exam in September 2018. There are other videos in the series which will debrief the remaining questions. In this debrief, I'll be analysing the requirement, showing you how to apply your knowledge effectively, and looking at some answer plans. In debriefing this question, I am assuming that you have attempted the question and have the exam to hand. Question 3 is a Section B question, and these will relate to testing accounting standards and how they are applied in particular situations. It will test your knowledge and your judgment. Question 3 is broken down into two parts, and we can see here the requirement of Part A is further broken down into 3 parts. ISA 38 is identified as a key accounting standard. But in a good answer, by the time you finished, other standards will have been brought into the discussion, and A Part 1 is a standalone requirement for 6 marks. It wants us to explain the criteria both in the current version of the framework, the proposed revised version of the framework, and ISA 38 in respect of the recognition of assets. Now, being asked to do 3 things for 6 marks, it's reasonable to assume that we're going to pick up a couple of marks on each point. In terms of the current conceptual framework, the recognition criteria for an asset revolves around 3 things. It has to meet the definition of an asset. There has to be a probable economic benefit that will flow, and that economic benefit has to be capable of reliable measure. However, the revised framework suggests that the recognition criteria should revolve around the characteristics of useful information. So it wants the information to be relevant and faithful. So there's an entirely different approach between the old framework and the new framework. The examiner sets out a very good answer, and I'd recommend that you have a look at that for learning purposes. It does emphasize to me the need for you to be familiar with the framework. The requirement of A Part 2 wants us to discuss the implication in respect to the financial statements if the recognition criteria were met for the intangible assets, for the stakes in the intangible assets, but we should also consider the implications if the recognition criteria were not met. So there's 2 things here that we are considering. We need to have a look at the information in the question relating to the stakes. What we're being told about the stakes is that Skies has made an initial payment, and in X7 it has treated these as intangible assets because at that time it believed it met all the criteria and they had anticipated future economic benefits. But then in the following year, in X8, they've actually expensed those because they are unsure whether the payments should have been initially recognized as intangible assets in the first place. So they then in X8 have doubts about the situation that the correct treatment was applied in the previous year. Now there's 2 things that we have to consider. First of all, if it was right to have originally capitalized the asset. If it was correct in X7 to have originally capitalized the asset, we now are faced with a situation where we don't believe that we're going to recover anything from that asset. And if we were correct, what we now realize is that we can't recover anything from that asset. So instead of it being a change in an accounting estimate, because we can't recover anything from this asset, what we should be doing is an impairment review. This is all about impairment. Yeah, this is all about ISA 36 if we were correct last year. If we were incorrect in X7, then there's a different answer. Because if we were incorrect in X7, we'd made a mistake last year. We'd made an error last year. This had been a prior period error. And as a result of a prior period error, you restate last year's accounts. Interesting, isn't it? The answer to this question is not really about intangible assets. We've had to think through and apply our knowledge in respect of impairment and prior period adjustments, prior period errors. Let's have a look at A part 3 of the question. A part 3 of the question wants us to discuss whether the proceeds of the development project should be treated as revenue. So immediately I'm getting very excited because I remember IFRS 15, revenue from contracts with customers, and I think of the 5 steps. But we need to look at the information in the question. Now, when we read the information in the question, we discover that they've acquired the development project as part of a business combination, and they correctly recognized it as an intangible asset. Now, it seems to have suffered an impairment loss. They don't think they can develop it. They can't find a joint venture. They write it off, but they decided then to sell the project. And they succeeded in selling the project. And as the project had a nil carrying value, it treated the sale proceeds as revenue. I find that a strange justification. Why are you treating it as revenue because the carrying value was nil? That doesn't make sense to me. Alarm bells are beginning to ring. Now, whilst I agree that revenue is recognised when control is passed, I'm also rather concerned that the directors have argued that the sale of rights was part of their business model. I need to reflect. What is going on here? We have an intangible asset, which we've correctly recognised as an intangible asset, then written off, and we're now getting rid of, and we're claiming it's sales, we're claiming it's revenue. That implies that it's part of our day-to-day operations. I don't think this is revenue at all. I think this is an asset that we have disposed of. I think, therefore, it's a profit on the disposal of the asset rather than revenue. Interesting again, isn't it? Yeah, how we get involved in looking at different accounting standards and how we have to use our thought processes. Too many students answering this question simply wrote out the 5 criteria, the 5 steps for revenue recognition. That was not what the question was about. That would not have earned you marks. Let's have a look at the requirement B. Question 3 part B is for 10 marks and is very much a discussion question. We're looking to discuss the potential issues which investors may have with accounting for different types of intangible assets, the choice of policy, the capitalization of development expenditure, and whether integrated reporting might be part of the solution. It's interesting for me that we've got an angle here. We're looking at it from a point of view of the investor, a particular stakeholder. And this is something that will recur in future examinations, looking at problems from a stakeholder perspective. The question gives us a scene setter, and there's a lot of useful information contained within this opening paragraph that gives us a context and a flavour that's going to inform our answer. It talks about how investors find making comparisons difficult. It talks about how intangible assets may not be reported. And so when a question like this comes up again, it's always important that you look and study the information that you're given, because you're given it for a purpose, and that purpose is to help you construct an answer. Now we've got 7 marks for part 1, and it's broken down into 3 parts already. And the first part is asking us to discuss the potential problems in accounting for different types of intangible assets under a business combination. There are 2 types. You've got the goodwill, and you've got the intangibles, the other intangibles, if you can separately identify them. And they've got different treatments. Goodwill has to be subject to an annual impairment review, but the default for an intangible, if you can recognize it separately, is amortization. Now, if you can't recognize the intangible asset separately, it ends up being subsumed within goodwill and gets treated in a different way. Secondly, the question talks about a choice, that there is a choice of accounting policy between cost or revaluation. What do I think about choice? From an investor's perspective, maybe choice reduces comparability, because some companies will do it and some companies won't revalue their intangible assets. And comparability is an enhancing characteristic of useful information. You could argue, however, that ISA 38 does require there to be an active market in the intangible, so actually not many companies will revalue their intangibles. Thirdly, the capitalization of development expenditure is a massive judgment call, and different businesses will have different levels of risk and different levels of attitude as to whether or not they're going to capitalize their development expenditure. And sadly, a lot of companies who spend money on R&D don't necessarily always capitalize those assets, so we can't see the costs that they've incurred being recognized on the balance sheet. Discuss whether integrated reporting can enhance the reporting requirements. Yes, of course it can. Because what integrated reporting does is talk about capitals, talks about the future, talks about not just about financials and past, but talks about the value that we are creating in our intellectual property. This is an interesting question. It's a very current question. You've got businesses like Uber, Airbnb, Just Eat, who spend a massive amount on developing their brands, on developing their systems, and they are very, very valuable companies, but the money they spent on their brands and their systems are not necessarily reflected in their balance sheets as assets. Please have a look at the examiner's answer. Please think about accounting issues from the perspective of different stakeholders. Let's have a look at the key takeaways from our debrief of question 3 from the September 2018 SBR exam. The conceptual framework came up. It's important. It will come up again. Current issues featured. They can appear anywhere in the examination. When accounting standards are examined, it's not about regurgitating the facts. Accounting standards are tested through scenarios. Sometimes it's necessary for us to actually identify what accounting issue we're being tested on and to reflect. It was not immediately apparent, perhaps, that the intangible asset needed to be impaired, if there was no longer a recoverability. It was perhaps not immediately obvious that if last year they had done things incorrectly in recognizing the asset, that was a prior period error. It was perhaps not immediately obvious that if you were selling an intangible asset, that was not revenue because that was not stock, but that was actually the disposal of an asset. There's the need to think. Part B of the question addressed the issue from a stakeholder perspective. And that's going to again be a feature of the examination going forward. Stakeholders thinking about their perspective, why they're looking at the accounts, what they're interested in. This is one of a series of question debriefs. You'll also find the examiner's report and the full answers and other fantastic resources on acccaglobal.com. Good luck with your SBR studies. I hope you found this debrief useful.